What's up everyone? In today's video I'll explain you exactly how I identify the valid break of structures and how I try to filter out those bad ones. So this took me a little while to figure out. I think this is the most valuable skill you can have, because with knowing how to spot valid break of structures, you also know when the market is going to reverse, and you'll more likely catching those big moves. So if you stick to the end of this video, I'll explain you exactly, I think in 3 or 4 ways, how I approach finding valid break of structure. So I'll also give you live examples, so make sure to watch the full video, and let's dive right into it. So first of all, I want to say I trade from liquidity pool to liquidity pool. So what that means is I look for highs and lows and maybe order blocks, fair value gaps, breaker blocks, whatever nice confluences above a high or below a low to find my points of interest. So if we are not inside a point of interest, so if we didn't take out any liquidity and we have a break of structure, then I'm not trying to play the move, because I think the market is not ready to reverse yet, because as you know, we need liquidity in order to shift the market, right? So for example, here we may be having a break of structure to the downside, but this is my main objective for reversal. So this is my draw on liquidity, and if we take this out, then I'm only interested in some kind of confirmation pattern right here. So if this was like this, then this would be really interesting. I would enter right here. So therefore, first way how I try to filter out the bad ones is make sure it's inside the liquidity pool. Now of course this can be a real break of structure, because maybe there's a demand zone, a supply zone, sorry, right here, or some fair value gap. Then of course this can be a nice reversal, but I just like to play those A+ setups, and I find during my backtesting and during my live trading that my best setups come from just taking out major liquidity, external liquidity, like this external high, and then forming some kind of confirmation. Of course, I also trade like order blocks and stuff, but that's like my B setups. I de-risk on these. So yeah, that's the first thing. I really want to be in a reversal point of interest. Now, to give an example on the chart so you can understand it better, for example here, a lot of people, they would maybe be interested in shorts on the retracement right here on the middle of the fair value gap, but what they don't see is that the high that led to this break of structure, it didn't sweep any liquidity. I mean, the major liquidity is resting above here, right? And so once we actually see this liquidity being taken out here on this move, these people who shorted right here, they got their stop loss hit, and this is where the market maker orders got filled, so to say. And that's when you really can identify a shift right here, for example, and then this high should be protected, so you see doesn't get stopped out, and we continue the trend. So I really want to see like a nice liquidity pool. A high is not just a liquidity pool, like taking out the high. People will say buy side liquidity and sell side liquidity taken out and break of structure. No, you really want to see more in order to be a nice setup. So I mean, this is actually like maybe a supply zone in the premium, maybe some fair value gap on the lower time frame, and with a lot of highs, not just one high like this. This is not a nice liquidity sweep right here. This is. So yeah, that's just something I want to say. You really don't want to just short every break of structure to the downside like this, because then you get because the major liquidity is not taken out yet. So I think you guys got some view on what I mean with this. So next up, what I like to use to identify valid break of structure is actually multiple time frame confirmations. So I basically use the minute 5 and the minute 15, and I use them in confluence. Like my main confirmation time frame is the minute 5 time frame. So let's say we have a break of structure like this on the minute 5 time frame, right? So okay, a lot of people, they might short right here on the retest like this, but if I check on the minute 15 time frame, we basically close above it and we just form a wick, and we just literally just mitigate this order block, support area, fair value gap, whatever. Then basically this was just a sweep, right? So that's why I'm saying I really like to use multiple time frames in confluence and in order to just identify valid or fake break of structure. So if we close below here on the minute 5 time frame, but we don't close below this low on the minute 15, then this can be a sweep and it's dangerous to play it. Now, to give you an example on the live chart, actually this morning on Euro GBP, there was a great example of just avoiding a fake market structure shift. So a lot of people, they may be waiting for a reversal once these highs got taken out. We got some sweeps, okay, we're ready to reverse. Many people, they want to see this low right here being broken in order to just play something like this, right, to short it to the sell side. So what did they see? They see actually the candle, the minute 5 candle, it closed right here below the low. So what did they do? They maybe just wait for a retracement. Right here they entered on the middle of the fair value gap and they played this short, right? But actually on the minute 15 time frame, this wasn't a close. So that's what I mean with multiple time frame confirmation. I really want to see favorably, actually the best thing I want to see is the minute 5 to close below the minute 15 also, which isn't the case here, and also some candles opening and closing below this low, because as you can see right here, it closed below it, but the next candle immediately closes above it, and then a few candles after it just rips, right? So you really want to see maybe another minute 5 candle open here, close here, another one, the next one open, close, and that's when you really can play off these breakout structures. That's how I learned to play the good breakout structures. So use multiple time frames and wait for multiple low time frame, whatever time frame you use, candles to close below a low if you're going short, or close above a high if you're long. Now let's see if we can find another example. I marked something out right here. Yes, so for example, here again on the minute 5 time frame, what does this look like? Minute 5 time frame, okay, maybe people want to short once this high is getting swept right here. Okay, we immediately get a displacement, so everyone was trying to short, right? Because we get a break from maybe this nice low, right? On the minute 5, this looks like a breakout structure. A lot of people, they probably did something like this. Stop loss right here, enter on this fair value gap, and just targeting lower, right? Because sell side was swept and we get a breakout structure of the low. But on the minute 15 time frame, this isn't a close, right? And also on the minute 5 time frame, the next candle closes back above it. So you really want to see it close back below it. And the result is we just rip because this is a fake breakout structure. Now, the last thing I use to identify fake and valid breakout structure is actually just pure price action. For example, we have been inside the liquidity pool, so that's my first rule, right? I'm talking about reversals. I really want to see external highs or just like big highs being taken out before counter trading the mid time frame in order to play the daily bias around liquidity. So what do we see right here is we have a high, we have a low, we have a high, and what we want to see is we want to see this low being broken. Why? Because this low brought us to our last high. But let's say we have a low right here and we basically get a break of structure, but this is not a valid break of structure because we want to see this low being broken, right? Because this is the low that brought us to our last high. This is not like a relevant low, right? So that's why you can maybe see something like this, right? If you entered right here on this break of structure, stop loss right here, target here, you would have been stopped out because this is the low that you want to see break before anticipating on any entries. So this is just talking about pure market structure, pure price action. To give you some examples on the chart, actually the same example, but now talking about this way of identifying the valid or good break of structures. I think this was also in Euro GBP. Yes, so we talked about minute 15 and minute 5 confluence, so just using 2 time frames in order to confirm it. But actually also, let's say you really just entered on the minute 5 break of structure. A lot of people, they don't understand that this is actually not the low that should be broken, but actually this should have been the low that needs to get broken, and this is just a wick into it, right? Well, why would you ask? I see it like this. We get this nice point of interest. What do we get? We get one sweep. I'm gonna make it a little clearer. One sweep right here. Then we got a retracement, a second sweep, okay. Then we got the low, then we got the high. Okay, so I see it like this. This is the low. These are just internal lows. Not interested in this, but a lot of people, they will use this one, but actually this is the low that brought us to our last high. This is our last high. So actually this low should be you should use this low as your break of structure low, not this one, because high, low, right? If you are planning to go short, you really want to see the low that brought you to the last sweep being broken, not any internal low. You want to see the low that brought you to the last sweep. You want to see that being broken in order to play the retracement down and short it towards some sell side liquidity. Now, if you're planning to go long, you really want to see a break of structure of the high that brought you to the last sweep's low. So we mitigate, I'm just gonna do it with my hands, we mitigate some nice demand zone, for example, or so for value gap. One sweep, second sweep. Now we want to see now a break of structure of the high before the second sweep. So the high before the last sweep, that's the high, not any internal one. So maybe some other examples. For example, why is this a valid break of structure? So 1, 2, like this. This is the low that you want to see break, not this one. For example, this is the last sweep of some kind of POI mitigation. Now, what is the low that brought you to the last sweep? Not this one, right? Because we have something like this, right? I just see it as sweep. So we have one sweep, didn't create any higher high right here, not any higher high right here. Here we do. This is the low that brought you to that last sweep. So you want to see this low getting broken in order to shift a valid break of structure. For example, not this low. This is not the break of structure. This is not the break of structure. Maybe they're equal, but it's just like in theory, right? You really want to see the break of the low that brought you to the last sweep's high. You really want to see a break of the high that brought you to the last sweep's low. So again, why did these people got stopped out after they identified this break of structure? Because this is not the low that brought you to the last high. This is. Okay, maybe some last example. I'm just trying to eyeball these. But let's say right here. Okay, it's just a stupid example, but to just make it extra clear. Let's say people identify this as a high. They see this break of structure, right? A lot of momentum. Let's go to the top, right? But actually, you want to see a break of structure of this high, right? Why? Because this right here is the high that brought you to the last low. Well, no, actually, sorry. This is the high that brought you to the last low, right? We all agree. So what do we want to see being broken? We want to see this high being broken, right? And then we got a nice retest and we go up again. Now, a lot of people, they would use this high as a break of structure, but this is not the high that brought you to the last sweep. So for example, if we were replaying the chart, this would not have been a nice entry, just because this is not the high that we want to see getting broken. This is the high that we want to see getting broken. Of course, it can happen. Of course, this could be a nice trade, but this is not like how I like to trade, and this is what I found works best for me. So of course you can say, I can trade this just next minute 5 high being broken, break of structure, I enter on a 5 value gap. Of course, bro, just do your thing. But I just found out that it's very easy to just it's very handy to just see the price action develop and basically always have something like this, right? We have some kind of nice point of interest, and then we really want to see something like this if you want to go short, but not something like this. So this is the right way, this is the wrong way. So this is not a valid break of structure, because this is not the low that brought you to the last sweep's high. No, this is the low that brought you to the last sweep's high. So you want to see this getting broken. Didn't get broken, so this was just maybe a demand zone fill, and then just go higher. So I think you understand. It's the same thing if we invert the chart. So this is the last sweep's low. what is the high that led to this is this one. So you want to see this being broken, not some internal high. So here again, you want to see this getting broken. This is not valid high to identify break of structure, because this is not the high that brought you to the new low. This is the high that brought you to the last low, and this is the high that you want to see being broken in order to confirm that break of structure. So the fourth way I try to identify a valid break of structure is what everyone tells you. It's the simplest thing, is just displacement. So you don't want to see like a little candle close like this. You don't want to see it like this, because then it can just be a liquidity sweep. You really want to see like a momentum, and especially, let's say, if there's some fair value gap right here, you really want to see it just not mitigate this fair value gap, and really some displacement right here. You get what I mean? So displacement is not the same as a break of structure. A break of structure is also this, but this is not a displacement. This is a displacement and a break of structure. This is only a displacement, a break of structure, sorry. So displacement is the most important thing. Just volume. What you want to see is not just a big wick on the top. If we see a break of structure to the upside, you really want to see a full body close, so no top wick. I mean, you can have a top wick, but it's the best thing to just have like a really strong close above a high, or really strong close above a low like this, and not just like a sweep, because then it can just maybe go up. Okay, that's about it. I hope you had any value of this video. Lastly, I just want to say that it's just a combination of all these things I now use to identify the good ones. There's no good or bad thing to do. It's just about how you approach this, how you mix things together, and how you understand and how you would like to understand the market, because in the end we're just always learning the same thing, but we just have a different framework. So it's just important to especially not blame other strategies for not being good, because every strategy can work if you just put time in the markets, if you refine it, and just mostly if you put time in it. Okay, I hope you had any value in this video. If so, a like and subscribe is appreciated. I'll wish you an amazing rest of your week, and I'll see you guys in the next one. Peace.